All right, let's talk about Lakeland Industries. We're breaking down their latest earnings call from September 9th. Now, on the surface, this thing looked like a home run, a record-breaking quarter. But the market? Yeah, it wasn't impressed. So we're going to dig in and figure out exactly what's going on.
So here's how we're going to break it all down. First, we'll hit the Q2 report card. Then we'll look at what's really driving their growth, which is their fire services division. After that, we got to talk about the headwinds, the things that are causing some trouble. We'll wrap up with what management's planning to do about it, and of course, our final rating on where this stock is headed.
All right, let's get right into it. Section 1, the Q2 report card. And boy, is this a tale of two completely different numbers. So first up, the good news, and it's big news. Lakeland posted record net sales of $52.5 million. I mean, that is a massive 36% jump from the same time last year. A huge part of that is coming from some smart acquisitions they've made. By any measure, that's a fantastic number.
Okay, but here's where the story starts to get a little complicated. You see that record growth? Well, it wasn't quite enough. They actually missed Wall Street's expectations by about 5.7%. And you know how it is. In this market, you just can't miss on that top line. The street does not like that. And yep, there's the reaction. The market did exactly what you'd expect. The stock dropped almost 4% in after-hours trading. So pretty clearly, that revenue miss spooked investors way more than the record growth impressed them.
So that really gets us to the big question, right? You've got record revenue. So why on earth did the stock drop? What did the market see that the headline number was hiding? Let's find out.
Okay, to really get what's going on, we have to look at the growth engine. This is the story behind the growth. Lakeland has made a huge strategic shift, betting big on the fire and safety sector. And believe me, that's where all the action is.
Just look at this revenue mix. It tells you everything you need to know. Fire services now makes up almost half of their entire business, 49%. This is not your father's Lakeland Industries. They've been buying up companies like Viridian, LHD, and Eagle, and it has completely changed the game for them.
And wow, is that bet paying off? Sales in fire services are up 113%. I mean, they more than doubled year over year. A big chunk of that is from the Viridian acquisition. Plus, they landed this huge $3.1 million boot order in Italy. Not to mention, US and Europe sales are on fire. This right here, this is the growth engine.
So, if that growth engine is humming along so nicely, what's the deal? Why the stock drop? Well, this is where we get to the challenges under the hood. The market basically looked right past that amazing growth and zoned in on a couple of pretty big headwinds.
First up, geography. It's a real mixed bag. On one hand, you've got the US and Europe absolutely crushing it, but then you look at Latin America, and sales completely fell off a cliff, down 42%. Management is saying it's because of tariff uncertainty causing delays, but wow, a drop that big is a huge red flag for investors.
And the other big worry? Margins. Look at this. Gross margin dropped 370 basis points from last year. Now, what that means in plain English is that even though they were selling a lot more stuff, they were actually making less profit on each sale. Blame it on acquisition costs, those tariffs again, and materials getting more expensive. That's called margin compression, and it's something that Wall Street absolutely hates.
Okay, so we've got the good and the bad. The challenges are pretty clear. So the big question is, what's management going to do about it? Let's look at their plan for navigating this turbulence. And they are not messing around. Their plan is aggressive. They're shutting down a warehouse in the UK and a plant in Arkansas. They also did a sale-leaseback deal in Alabama, which basically frees up cash and helps the balance sheet. All in, they're aiming to slash about $7 million in annual operating costs. That tells you they are dead serious about getting profitability back on track.
And they're also being realistic with their guidance. They basically told the market, hey, we're probably going to end up near the low end of our sales forecast for the year. They also tweaked their EBITDA outlook. It's a pretty clear signal that they don't see these tariff problems or the weakness in Latin America going away overnight.
Okay, so let's put this all together and figure out the so what. You've got this amazing growth story on one side, and then you have margin pressure and this black hole in Latin America on the other. How do you make sense of that? And what does it all mean for the stock going forward?
I think the phrase that sums it all up perfectly is cautiously constructive. It's like, yeah, you're excited about the record sales and what's happening with fire services, but at the same time, you just can't ignore the risks from the tariffs and what's happening in their other regions. It's a real mixed bag.
So, after weighing everything,
We're giving Lakeland Industries our official rating, Market Perform. What does that mean? We think the stock is probably going to move pretty much in line with the overall market for the time being.
And here's why we landed there. First, that growth in fire services, it's the real deal. Absolutely impressive. But, and this is a big but, the shrinking margins and the disaster in Latin America are just too big to ignore in the short term. Now, management is doing the right things with cost cutting, for sure, but those changes take time to actually hit the bottom line. So until we get some clarity on the tariffs and see Latin America start to bounce back, we think the stock is pretty fairly priced right now.
All right, now for my favorite part, the trade idea. This is for the more institutionally minded folks out there, a little something you might hear tossed around on a trading desk.
So what is it? We're talking about selling cash-secured puts. If you're not familiar, it's actually pretty simple. It's an option strategy where you sell someone the right to sell you the stock at a specific lower price. In return, they pay you cash, a premium, right now. So you're basically getting paid to sit back and wait for a better price to buy the stock.
So here's the play. You sell puts at, say, a $12.50 strike price. This fits perfectly with our cautiously constructive view. Here's what can happen. 1. If the stock stays above $12.50, great. You just keep the cash premium you collected, and you walk away with a nice little profit. 2. If the stock does drop below $12.50, you'll have to buy the shares, but you're buying them at a much better price than they are today. You get to own a great long-term company at a discount. It's really a bet on that long-term value, while getting paid to ride out the short-term bumps.
And of course, I have to say it, this is not financial advice.